I'm Ted Vidmar. I'm the CFO of Cove Capital Investments. And we're talking today about our most recent investment and our multifamily investments. But first, just a quick minute about Cove. Cove Capital Investments is a sponsor of Delaware Statutory Trusts, or DSTs. I think now we've bought over 110, maybe 111 properties, representing over 3 million in square feet.
Yep.
And we have about, I think the value is probably over $1 billion in assets under management.
Yep.
Our properties in over 35 states. We also have investments in other real estate funds, but today I'd like us to talk about our DST strategy in multifamily, and specifically with Sam Cimino about our investment strategy recently with the build to rent product that we're looking at. And so with that, I'd like to introduce Sam Cimino. He's a director of our acquisitions team. He focuses on multifamily acquisitions. So Sam, tell us a little bit about Cove Capital's multifamily investment strategy.
Yeah, so right now we're looking to expand our multifamily footprint, but specifically looking at build for rent communities right now. Tell you what build for rent is, or build to rent community is a purpose-built community with single-family home layouts. So that gives millennials or young families opportunity to be renters in a single-family home in a large community, especially as homeownership has become more and more difficult. Rise in interest rates, rise in single-family home prices. You're actually looking at now the median home buyer age has risen to 56 years old.
56 for is that the average or a new first time?
That's the median for a first-time home buyer.
A first-time home buyer.
Yeah.
Over 56 years old?
Yes. So these communities allow for young families to come in and rent at lower risk, of course, and a little more flexibility to come into these homes. But at the same time, you see a lot less turnover than multifamily apartments, being that a family is moving in, really moving their life into these homes. We can go into these homes in specific in San Antonio that we're looking to purchase. So these are 83 build-for-rent homes in San Antonio in the growing Alamo Ranch community. They're about a little over 1,800 square feet on average.
Wait, I'm sorry, Sam. You said how many square feet?
1,800.
1,800. How many bedrooms is that on average?
So they're 3 and 4 bedroom layouts. So 3 bedrooms with 2 baths, 3 bedrooms, 2.5 baths, 4 beds, 2 baths, 4 beds, 2.5 baths. There's 6 total different layouts.
Wow.
And they range in size from about 1,300 to 2,200 square feet, with the average being 1,800.
So when we talk about a build for rent home, are you saying there's like a backyard, a grass in the front, or tell me about what it kind of looks like as you approach it?
Yeah, so exactly like walking or driving through a suburb.
Really?
The houses have front lawns, they have backyards, especially these, which I was at 2 weeks ago. I was visiting them. You'll see some build-for-rent communities, the homes are smacked together.
Yeah.
With very little space. This really felt like being on a regular street in a regular town, except it's in a large master plan community.
So obviously, if you've got young families who perhaps can't yet afford a down payment, or interest rates in today's interest rate environment, the interest rates are just make it too difficult to buy a home. But if you're raising a young family and you want to have that single family home experience, what else is there other than this type of opportunity? This sounds like a perfect opportunity for that family.
Yeah, it definitely beats a townhome or any larger apartment, because this really gives you the same feel as owning a single family house, right? And you're in this community, going to the community amenities that this has.
Yes, please.
It's really like a small town. I mean, there's a school in the master plan community. There are 2 large pools, one with a very large resort style, almost lap pool, with a lazy river and a large water slide.
Wow.
There's multiple pools and water slides, one being the main one, which is very large with the lazy river. You have basketball courts, pickleball courts. You have a club room and amenity center where they throw different events for all the residents. Think bingo night or Easter egg hunts for the kids around the community.
Sam, this is incredible. Wait, so multiple pools, and you said a lazy river?
Yes. Yeah, there's a lazy river.
That goes around the pool areas?
It goes around. It goes around one of the pool areas, around the slide that comes down. You have cabanas, umbrellas.
How far away is that than the properties that we're acquiring?
So it's a short drive. It's a very short drive within the community.
Okay.
You're not going back out onto the main street to get there.
Traffic lights, traffic crossings,
No,
just a couple of stop signs.
just
Couple
some
blocks
stop
away.
signs. That's all. I mean, you can take a golf cart, you can take a bicycle, you can walk. It's pretty hot right now, but you can walk if you choose. But it's very, very accessible for both adults, children.
So when you said other amenities, let's go through those again. Other than the pools, you said multiple pools, 2 pools,
two pools,
the lazy river, and then
lazy
what
river,
other
water slides, splash zone for the kids. You know, like kind of at a theme park where the water comes out the ground. Multiple playgrounds, full swing set, slides, the whole thing. Large grass areas that are available for community to use. There's the fitness center. There are basketball courts and pickleball courts as well.
Wow. So with this type of opportunity, it sounds like young families of all kinds are going to want to be able to rent here if they can't afford their own home. This would be a perfect opportunity. They can rent. What are the rents like? Are they affordable? How do they compare to like a renting in some other single family home?
Yeah, so right now the market rent for the average for these size of homes is $2,400 a month. So ours range, they go from $2,100 to $2,600 at the moment, but there is room for potential growth in NOI here.
Okay.
Homes are slightly below market right now in the community, as there was a lease up. We're now just about fully stabilized. There's only one remaining unit that is vacant, and that was being used as a model unit / leasing office. So
Okay, so our properties that we're acquiring for this investment opportunity in this DST are 83 homes
yes,
in this particular tract within this larger planned community. And you're saying all but one is leased up already. So from
Yes.
an investor's perspective, we're earning income on day one.
correct.
And the one that was not leased was a model that will soon be leased.
Yes. So that was being used as the model / leasing center.
So from an investor's perspective, they're acquiring a DST interest in 83 homes, not individual homes, but the actual entire 83 home contained property area is all owned by the DST, and investors will own an interest in all of these properties collectively, and they're all ready rented except for one, which will be rented out soon.
Correct, yeah. They're built in 2024 by one of the nation's largest home builders. Incredible build quality, modern finishes, and amenities. So you have tile backsplash in the kitchen. You have granite countertops. You have smart home access throughout the home. And it's no carpet is a big thing for me that I liked. It's just plank flooring. A lot of them come with carpet. It makes it a little difficult to turn over, but no carpet at all. It's beautiful. Stainless steel appliances. And these are all still the first renters. So there has not been any turnover yet. These are all first generation that have moved into these properties, and we expect them to stay for a while. And if they move on to buy homes, we're also happy for our tenants as well, upgrading their lives. And we're confident that these will continue to remain full because the value is there and the product is there.
So it sounds like our investors would not have a substantial risk or an unusually high risk related to vacancy, because if somebody does decide to move out, there's going to be somebody else available to move in based on the rental market in this area and what these rents go for compared to other rental homes in the area.
Yeah, I mean, comparing it to just apartments nearby, the rates make sense. As well as when I spoke with management there, they said this was the fastest lease up they've ever done. They said the product just sold itself. We said, here we are. People started signing up to move in.
That's incredible. So from an investor's perspective, let's talk about the management of the property. Is there an outside property manager then? What happens when a tenant is going to move out, or we need to find something else, or there's a problem with the unit? Who do they call?
Yeah, so we do already have a good relationship with our property management company in San Antonio that we use for other multifamily assets that we have in San Antonio. Personally, I walked the property with the property management company as well. They brought their team. They got a feel for the property. They gave me their insights. We don't need any management on site, especially after it's fully leased. They do everything remote. Tenant will call the property manager. Property manager will call out vendors as needed. They'll collect rent as needed, and in the beginning, these properties actually have warranties. So for the first couple of years, more than likely, we're using the warranties trade vendors that are coming out. There will be very little that we need to do hands-on there. A lot of it will be ran through the warranty.
Sam, that is an excellent point because, again, for a DST investor, oftentimes there can be concerns about how much work will the property will be required of the property. Will there need to be substantial reserves? And what I hear you saying is that really there will be very low reserve requirements in this DST structure because the properties are so new and they have existing warranties on the roof, the building, all the amenities that are needed will all have warranties. So we feel very confident that the investors, again, do not face more risk and needing to have higher reserves.
Correct, yeah, but we still underwrite very conservatively, even though we find potentially a very low risk in the first couple of years. We underwrite conservatively so that we can hit our pro forma numbers, for our investors and deliver strong returns, and continue to pay out what is noted in the PPM.
Okay, fantastic. Just another quick word about as you were talking, I was thinking about the property and the amenities that are available. We talked about the ones that are slightly off-site. Let's talk about the property itself. The backyard, is it grass? Is it fenced? Is there room for pets?
It's a fenced grass yard. There's room for pets. I have a little table, chairs. However you want it outfitted, there is enough room. Again, some of these that you'll look at, it has just this little small side yard, almost the size of a balcony. This has a decent sized backyard, enough for a family to be able to do some activities outdoors.
Wow.
It's not, they don't have their own pools. It's not a very large backyard, but it is more than enough.
Well, again, if there's pools close by, who wants the added hassle and cost of having a pool on site? It can also be dangerous and some other issues. So I think that, again, from an investor's perspective, this is a great way of helping them modify, the risk associated with these particular properties. That sounds like an amazing opportunity.
Yeah, and brand new pavement all throughout, as you can imagine. The HOA takes care of all amenities. Everything is always clean, street cleaning. Us as landlords take care of all the landscaping in the front, so everything is always uniform and all grass is always cut. And this community will continue to look new, for years and years to come as we maintain it.
Fantastic. Now, you said that these were built by one of the nation's largest home builders. Can you tell us more about these particular 83 units? Tell me more about the overall community that they're in, that the developer has built. How large is it? How much experience does the developer have in building these types of homes?
So the developer, this is really what they do. They build homes and they build large communities. Extremely large public traded company. And what they need to do is they need to build these homes and they need to offload them quickly, right? And that gives us an advantage coming in as a cash buyer and buying a large chunk of them versus them going out and selling them one-off. We're buying these at a large discount compared to selling these homes one-off. And that gives us opportunity in the future as well to sell them individually if we so choose. Being debt-free, we have the flexibility to hold these for as long as we need, sell them whenever we find appropriate as well. So the builder builds these. This is in a larger community called Riverstone. Our 83 homes are called the Arbor at Riverstone. So Riverstone is about 1,000 homes of a master plan community in Alamo Ranch. And this builder builds these all over the country.
Fantastic.
I don't know how many states they're in. It's close to 50. I don't think they've reached all 50 yet, but they build these all day, every day.
So an investor would be buying a product that's been built by a reputable builder. And as an investor and as a sponsor of such DST interests, we can make sure that our investors are going to be safe. In fact, you mentioned debt-free, and I think maybe we should talk about that because for Cove Capital Investments, one of our key strategies is to only offer debt-free product. Now, why that is advantageous for our investors is because there's no risk of foreclosure if you don't have any underlying debt on the property. You can't lose it. And in a DST, probably perhaps one of the most dangerous aspects of owning a DST is if there's underlying debt and there's a problem with the tenants or the rent and it's not sufficient to be able to cover the debt, the DST can get in trouble. We don't have that issue at Cove Capital Investments because we're completely debt free. So with that being said, you're saying you're able to go in and negotiate a good deal with the home builder in buying this 83 tract because, again, we can close quickly. We're not relying on waiting for a loan or approval for a loan. We're completely debt free.
Yeah, that was our advantage compared to other offers that came in with them. Even speaking with them, they said, we work with some other large entities. They always put debt on our product that they buy. You guys are actually the first ones we've dealt with in your space that's doing it debt-free. And that's really our advantage here. And we get a bulk discount buying 83 homes. Just like shopping at Costco, you might not need that many bag of chips, but you get a deal on it, right? The more you buy, the more of a discount you get. So that's something that is our advantage here and something we hope to continue to do and continue to build a relationship with not just this builder, but more builders to come as well.
Well, this sounds like a great opportunity. I know our investors will be very interested in it. Can you tell us a little bit about how our multifamily strategy? Because I know in multifamily opportunities are very important to our investors. And tell us a little bit more about other multifamily properties you built. In fact, Sam, over the course of your career, how many multifamily properties have you been involved in?
Total multifamily properties, probably about 3,000 to 4,000.
I'm sorry, 3,000 to 4,000?
I did a lot of single family home rentals before being at Cove. And before being at Cove, just single family home rentals alone, we did over 3,000.
I knew it was a lot, but I had no idea it was that many.
Yeah, about 3,000 homes at a time, but they were never one community. These were spread out. These are spread out portfolios. You buy 5 here, 10 there, 50 there. This is a very different and unique opportunity, whereas before what I was working on was buying properties that were built for a homeowner, for an owner user, but we became the landlord and started renting them out. This is specifically built for renters. It's designed for people to stay. It's designed for renters, and it's amenitized that way as well, is what's interesting. And what we're looking to do at Cove is we're looking to continue to do build-for-rent communities, but also multifamily traditional apartment buildings, whether they're garden style or more vertical traditional buildings. We're looking for more stabilized, newer construction properties, especially now in kind of a down market. We have the opportunity to come in and buy these properties at a discount from what we were seeing 3 years ago. So we're able to come in and buy some newer construction that doesn't require as much value add.
That's a good point, Sam, because I would imagine from an investor's perspective, they're always wondering when's the right time to get in and to acquire DST property. And of course, for us, we want to make sure that we buy the property at the right price. That's paramount to our success, is making sure we buy the right property at the right price. I would imagine because we're debt free that you're able to find opportunities where perhaps current owners need to exit their existing property because of a pending mortgage that needs to be refinanced, and at today's higher interest rates compared to many, or not too many years ago, that this provides us a unique opportunity to buy these properties quickly and at a really good price.
Absolutely. Whether it's the builder themselves that needs to get out of the deal, or it's the first buyer who oftentimes has an adjustable rate mortgage. And we've been seeing a lot of that with people with adjustable rates that are coming due or balloon payments coming due. And it's an opportune time for us to come in and buy something that's stabilized, newer construction, less risk. For a while, all you would see is the only way to make income before was a value add strategy. New product was so expensive in the multifamily space 3 years ago. Everyone was trying to do value add. It was the only way to generate a decent return. Right now, with the pricing that we're able to achieve, especially with distressed sellers, we're able to achieve strong returns on newer product that has less risk at the moment and that will have less repairs, fewer capital expenditures. And we're able to maintain these and still add value throughout our hold period, but it's not an immediate value add strategy that we need to come in and do large construction.
Sounds amazing. Hey, let's talk real quickly about our exit strategy, because I know from an investor's perspective, it's not just buying the right property at the right price that pays a good distribution to them, but they want to make sure they're not going to lose money on their investment and that there's an opportunity to sell the product at the end and to make a good increase in value in the purchase of their real estate investment. Now, we talked briefly about the property being able to be sold, or these particular single-family homes inside these 83 homes to be able to be sold. Are we able to sell those properties now?
No, there's a deed restriction that we will have to wait a little bit of time to sell them, but the opportunity is there in the future, or we're always able to sell the 83 chunk whenever we want.
Okay, so the 83, of course, we can sell if we get a good price for it for our investors.
Yes.
But if we wanted to put together a strategy to sell them individually, we just have to wait for that restriction to lift. Some number of years. Is it more than 10 years?
No, fewer.
Fewer than 10 years. Okay. Okay, so that's fantastic. So from a sales perspective, for our investors, knowing that they're going to get value out of their investment, we are going to have an opportunity when the properties are no longer have that deed restriction to be able to be a bit more flexible in the strategy that we use to sell, make money for our investors at the end of the DST's life cycle and go full cycle on this DST.
Correct. Yeah.
Sounds like an amazing opportunity.
Yeah, I appreciate it. I think investors will really like it, and I think it will generate strong returns, and I think that will, potentially be able to increase our returns year after year, hopefully as well.
Well, Sam, thank you very much. But before I want to finish this, I want to talk just a little bit about Cove, and we talked a little bit about who we are. You've got a good sense about what we're doing, and I want to make sure that everybody knows that we are located in Torrance, California. We've got amazing offices. Would love to share with our investors or potential investors. So if you ever have any questions and want to reach out and talk with Sam or other members of our team that are involved in our DSTs, we'd love to meet with you and to visit with you, and just call the information number, and would love to be able to have you come by and spend some time with us and learn more about us. So with that, thank you very much. Really appreciate your time. Sam, thank you.
Thank you.